Brilliant. Thanks very much indeed, Sarah. And hi, everyone. It's great to be here. Yeah, so as Sarah said, I am Ed Wallace. I am Director of Policy and Engagement at Locality. So for those that don't know, Locality, we're the national membership network for local community organisations. We've got over 1,000 members who are kind of working in neighbourhoods across England, and we support them to be strong and successful. We do that in a few different ways. So we provide kind of very practical, hands-on support for community organisations. We facilitate peer learning, so community organisations can learn from others across the country. We run national programmes, and we campaign for a more supportive policy environment. And really the experience of the last 15 months has highlighted, I think, just how vital community organisations are, and also the enormity of the challenges that they face. I don't know if anybody else is getting a fair amount of background noise. Just wondered if everyone could mute themselves, and hopefully that will make things a little bit clearer. So as I was saying, the experience of the pandemic has really brought into sharp focus the unique and vital role which community organisations play, but also the huge challenges that they face at the moment. So in June last year, we published a report called "We Were Built for This," which was our investigation of the community response to the coronavirus crisis. And it's just been kind of really inspiring to see that response. Our members really transformed their services, redeployed their assets, harnessed those relationships that have been built up over a long time, and we're often kind of up and running much quicker than the public sector response, really supporting their communities. And we've kind of talked about how we've seen a community moment over the last 15 months. But I guess this is all been happening at a time when members have been facing really, really significant pressure on their business models. I think in particular for community organisations who trade. So we've had lots of members say to us, we've done the right thing. We've kind of shifted away from grant dependency to trying to earn more of our income through community business, community enterprise, but then really found themselves in probably the most difficult position when that first lockdown hit and that trading income disappeared. So just to give a little example of that, in our member survey from last year, we found that 46% of members had said they'd lost a quarter of their income and 26% had lost half. But for members most reliant on trading, 62% had lost a quarter of their income and 37% had lost half. So a kind of, really significant impact on that. Funders and social investors have really kind of recognized that, and we've seen a big injection of a range of different emergency funds that our members have been able to access during the course of the crisis, and that, along with access to the kind of broader government support, does feel like it's kind of plugged the gap and stabilized the sector to an extent. But particularly as government support kind of starts to come to an end, we know it's going to be an incredibly challenging economic climate in the years ahead. So this is something that we're kind of thinking about a lot at the moment at Locality, and know that social investment has a really important role going forward for trying to create more sustainable business models in the future. So really looking forward to the event today and hearing from some of our brilliant Locality members who are on the panel today to hear about their social investment journey. So we are joined by Rob Trimble from Bromley by Bow, Imelda Havers from Yorspace, and Iftikar Karim from All Saints Action Network. And as I say, we're kind of really focused at the moment on learning of the experience of the pandemic, thinking about how we can create sustainable business models and the role of social investment within that. So delighted to be part of this event, and really looking forward to the conversation. So I will hand over to Mel at this point.
I heard you very well, so don't give me excuse.
And I wanted to speak.
I think we got a couple of people that probably just be. Oh, muted me then. That's taking it all a bit far, but yeah, that gives us a bit. Thanks very much, Ed. That's great. Yeah, really looking forward to this afternoon's sessions. I've got lots of people in the audience, so 65. I'm going to give you the most whistle stop of tours around, just give a little bit of context around social investment. But I know what we really want to do is to get onto the main event, and that's to hear from peers, so other locality members, about their journey and their experience of taking on social investment. So this session is called Communities Against COVID, and Ed really contexted both the challenge but also the opportunity. There was definitely a moment back in last April when, having spent 6 years working for Big Society Capital, I ran a social enterprise myself before that, I did wonder how much money that you have to pay back with interest. So social investment would be relevant. I wondered how far back this would set us. And actually, I think, against a background of the fact that there are many organisations that have been hugely impacted and where this is really challenging, particularly those, as Ed said, that have trading sources or revenue, particularly those that are a face-to-face customer, you'd usually be face-to-face. We've also seen a huge amount of innovation. And we've also spent a lot of time together as a sector lobbying government to make sure that any schemes that did come out were accessible. What I have learned is that, or not surprised about, is that social enterprise and charity and local community organisation leadership are always innovative and always will look at every tool in order to create impact. And so that's really what we're here to do today. So I am going to chair this session, which I'm going to ask each of the speakers to just give a very brief background. So we only have an hour, so I'm going to ask you to all try and stick to just 5 minutes. I know it's difficult because there's so much you want to say, but just to tell us, I always feel a little bit like Cilla Black. I'm so always worried then some people don't know about Blind Date, but I think there was a more up-to-date version. So it'll be a little bit about who you are and what your organisation does, what you raised investment for, how much you raised, and why did you do that. And we've got different organisations who are at different stages in their journey, which I think is really important. But mostly what we want to do is give you the floor space. I've already had a look at some of the introductions in the chat, which have been great. I know there's at least one organisation that's thinking about looking to raise money out there. So the most value you can get from this session is probably not as much as we love listening to Ed and I, but it will be listening to the peer speakers and then being able to pick their brains and ask the questions. So please do feel free to use the chat function to list down any questions that you might have. What I'm going to do is I'm going to start by introducing Rob, who is social entrepreneur and chief executive at Bromley by Bow in London. And I'm going to pose that question to you, Rob. So in your 5 minute sort of overview of, I know that's not enough, is it? Not anywhere near enough to do a little bit about who Bromley by Bow are, what you do, and then a little bit just about how you've social investment and how it's worked as part of the theme of Communities Against COVID. Over to you, Rob.
Great, thanks, Mel. Yeah, it's great to be here, and it's great to see such an array of amazing individuals and organisations here today. You mentioned Cilla Black and wondered whether that kind of aged you. I think we were members of both BASAC and the Development Trust Association, so that ages both our organisation and me. So we've been around this space for quite some time. It's great to be here. I'm Rob Trimble, Chief Executive of the Bromley by Bow Centre, have been for the last 20 years. The organisation itself has been around for about 37 years, and last month we made our first social investment, or took social investment for the first time. So we're not seasoned campaigners in this space, and in some ways I guess we might fall into the category of an organisation that has resisted social investment for 3 decades, but I'm happy to explain a little bit why we're we've engaged in an opportunity at this point. But just very quickly on Bromley by Bow. So we're, I guess, what you would call a community anchor organisation. We do quite a lot of stuff. Our annual turnover is around £4 million. We deliver quite a lot of services ourselves across the kind of usual range of community regeneration services, including work around social welfare, a lot of work around employability and skills, learning programs, and a social enterprise incubation program. So we've incubated around 85 social businesses in East London over the last 10 years. Our context is Tower Hamlets, and we continue to operate in one of the most challenging parts of East London, I guess. Pre-COVID, we were delivering across 27 venues in East London, principally in Tower Hamlets, but one or two other bits and pieces as well. And obviously COVID has had a massive impact. I should also say that much of our work, like many of you, isn't delivered in glorious isolation. We work in partnership with lots and lots of organisations to do that. I guess the principal partnership at Bromley by Bow is with primary care. So our model is very much predicated on the idea of bringing primary care together alongside community services. And I guess that's been a successful model. My role straddles both the charity, the Bromley by Bow Centre, and also the Bromley by Bow Health Partnership, where I'm a partner as well. But of course, this last year has been enormously challenging. So whilst our work around clinical medicine, the delivery of frontline primary care services has continued, albeit in a very altered form, like all of you, we faced this crisis last March of wondering how on earth we transform our normal portfolio of face-to-face services. And again, like many of you, we're a place-based organisation, so we are very much used to delivering our services on the front line as opposed to remotely. And to cut a long story short and to keep it brief, we've made that transition, I think, amazingly successfully. Like so many other organizations, we've been slightly bowled over by both the flexibility and capability of our teams, but also the extent to which many of our clients have been able to engage with this more remote model. That said, I think we are now discovering that we really also need to complement what we've learned and what we're taking forward from the COVID crisis with returning to being a place-based, face-to-face organisation that's never stopped. We're never completely closed over the last year, but that journey of bringing these two things together has been is where we are at the moment. So, what's the investment that we've just taken out? We literally borrowed this money last month, so I won't be able to do much of a kind of retrospective on it because we're kind of in the middle of it at the moment. But we, end of last year, just before Christmas, we engaged with a social investment business and the Resilience and Recovery Loan Fund. It's a really it's been a very, I should say, it's been a really successful engagement. It took a little bit longer than we expected, but not massively so. In fact, it seemed to be really efficient, actually, and we got quick turnaround on it. It was, I guess, for an organisation of our size, a relatively big loan. So we've taken out borrowings of 360,000. The fund is interesting and unusual, perhaps, in that it also provides grant income. So it's a sort of hybrid investment that they're making in us. So the loan element was 360,000, and the grant element was 144,000. So just over £500,000 of investment. The first year of that investment is interest-free, and obviously, and the whole term is 3 years. And so obviously we are very keen to be in a position as quickly as possible to pay off the investment that we've made. Why did we take it out? I think I would characterize it as COVID storm weathering of funds. So yeah, working capital to an extent, but not working capital that we're investing in new activities, but really a tool to try and reshape the organization in the direction that I described a moment ago, holding on to the kind of the history of our business, if you like, our organization, but also trying to invest in those areas which will make us more effective at delivering services by engaging with some of the new methodologies. Final thing I would say is that this is at a time when the needs within our community as a grassroots organization are dramatically increasing. A couple of weeks back, our chair, Ajit Lolvani, I thought captured it really well when he said that COVID has been, and I should say that Ajit is, as well as being the chair of our organisation, he's also Professor of Infectious Diseases at Imperial College, so he knows a bit about the kind of the context of COVID, and he said, COVID has been a torch shining a light on inequalities, but it has also been a wedge forcing those inequalities wider, and that's our experience. So a part of our reasoning behind engaging with the Recovery and Resilience Loan Fund was about how do we kind of make ourselves stronger in order to be able to respond to the increasing level of need within our community.
Fantastic. Thanks, Rob. That was such a great overview, and I'm going to come back to that. And what we've got here this afternoon is three quite different perspectives, which is great. That was the whole point. So I'm going to hand over to Imelda and ask her to do a very similar, just a 5-minute sort of pressy, and I think to tell you a little bit about Yorspace and what they've used investment for.
Thanks, Mel. Yeah, hi. I'm Imelda Havers, and I live in York, and I'm based in York. My business is based in York. I was until very recently, and I'm still very much a supporter. I was a director of, and I'm still a strong supporter of Yorspace. So it's that hat that I'm wearing today. In particular, I think what Yorspace does, I should say, just sort of very generally, we are a community-led organisation, which is a community land trust and a community benefit society, with the express aim of providing affordable homes for people, which are community owned in perpetuity. So we're looking at innovative ways in which we can secure homes for people, which they can own and afford to live in the long term, because York, like many cities, has a really major problem with affordability, lack of affordable housing. So what we have done, we identified a site about 3 or 4 years ago called Lowfield Green on the edge of York, and we have designed 19 community-owned homes to be built there, which are still unbuilt. We've secured the land from the council, and the funding mix until the beginning of COVID was a mixture of grants, resident deposits, and we raised about £422,000 through a community share issue. Then we hit COVID and everything stopped in terms of the grant funding. We were hoping to get community-led housing grant funding. That was an important part of the funding package. It just fell away. So what we've had to do is increase our mortgage borrowing and get things back on track, which we have managed to do, and we're hoping to start on site over the next few months, and it will still be affordable. So that's really good. But having hit COVID, having gone through the community share issue, which was a challenge in its own right, and I'm happy to elaborate on that further down the line if anyone's interested. We raised $422,000 primarily from small local investors over a period of 3 months. In amongst the drama of the Brexit negotiations and a general election. Unfortunately, we just got it over the line before COVID hit. So that's where we're up to. What Yorspace exists to do is not just develop Lowfield Green, but as a community land trust, we're also working with other areas of the community, because our aim is to deliver other affordable community-owned housing in other parts of the city too. So Lowfield Green is our start of a 10, if you like, and then we want to we've got other plans to move forward. That's where we are at the moment, and I'm very happy to elaborate on that, but it's a quick run through.
Thank you, Imelda. That's great. Already we're seeing here, the difference between like working capital and needing that, and then secured loans. And here we already have an example of working capital being loan or debt that you often hear talked about, and in your case, equity or shares. So let's move on and invite Iftikar into the conversation. We've known each other for quite some time, and I know that Asan have been exploring this both for themselves and also with their partners. So Iftikar, stage is yours for 5 minutes just to give those that context again.
Yeah, hi. We are All Saints Action Network. So we are a community development trust based in inner city Wolverhampton. The organization came together as a partnership of local organizations and resident activists in 1995 as a response to the closure of the Wolverhampton Royal Hospital, which is one of the most iconic buildings in the city. Residents and local organizations, they were concerned about the decline of the neighborhood, and they decided to do something about it. So we run, like most community development trusts, we own assets and we run community enterprises, and we provide community services. So we run a community hub and a community enterprise centre. We run a sports project. We run a day nursery, and more recently we've set up a recycling business focused on collecting waste wood and then turning that into something useful and diverting it from landfill. So that's who we are as an organisation. In terms of social investment, we've been on an interesting journey. So in 2001, the local authority decided to close the All Saints Primary School, which is a large Victorian building in the heart of our neighbourhood. And we started to develop plans to purchase that and to convert it into a enterprise and community hub. So we started to talk to funders in 2004, 2005, and we were steered towards talking to the Adventure Capital Fund, as they were then, and who are now the social investment business. And we quickly developed a kind of rapport with them, and they offered to give us 250,000 as a loan to kickstart the capital development project, because we needed to raise around about £2 million to purchase and refurbish that building. So effectively, social finance was the first kind of block within that capital package, and they gave that to us as a loan repayable over 10 years and at a rate of 5%. So we use that finance to purchase that building and to develop it, and it opened as a managed workspace and a community hub in 2008. So I think that was our first taste of social investment, and it's been a really interesting journey in terms of a community-led organisation taking on social investment, having the rigours of having to repay a loan, and becoming more enterprising. So during that period, we've moved from a grant-based position to a largely enterprise and contract-led situation. So that's the kind of journey we've been on, and we've kind of come a full circle now, because we're currently talking to Resonance and we're talking to CAF Venturesome, because out of COVID we've identified the need to create a dedicated entrance block for our community nursery, and we're currently talking to those social investors to try and raise about 220,000 to invest in our nursery and to make it a higher quality and a more appropriate space to meet the needs of local families. Okay.
Fantastic. Thank you very much, Iftikar. That's great. So here we've got a range of different organisations, some that started this journey a long time ago and then have come full circle, some that have been raising money more recently, and I love Rob's actually setting the scene about how you've moved and maybe resisted, and now it becomes more relevant. We've just done some research around that, which I think would definitely echo that. And then Imelda's view on Yorspace and you know, how you've managed to raise the money. I think the other thing that's quite incredible around this is, I think it does play to what I said before about the fact that organisations are still looking to raise money and have appetite to raise money and can see a way out of this. And I think despite challenging circumstances, we know how resilient our organisations are. So I'm going to, if I may, to the panel, I'm going to start posing some of the questions that are coming through in the chat. We've had some great ones already, but I'm sure that there will be more to come. So here we go. Let's have a first question for Rob. And it is, you said that this is quite early in the process and, you know, you've just taken on this money. And the question is, well, how do you know you're going to be able to pay back the loan? And I suppose, how did the investors satisfy themselves that you might be able to pay back the loan?
Yeah, so it's a really good question. I suppose fundamentally we can't be 100% sure that we will be able to repay the loan, but we have obviously made a judgment based on the kind of facts that we see in front of us to believe that we will be able to do that. And as I mentioned earlier, somebody was asking, I think, what the interest rate is. Interest rates in years 2 and 3 is 6.5%. So clearly we would like to get as much of that loan paid back as quickly as we possibly can. Obviously take full advantage of the interest-free period, but then get moving on it. How do we know we can pay? I suppose every organisation is going to have a slightly different story in relation to this. And for us, I think it was to do with the general trend in our trading. So we've had a really difficult kind of trading position over the last 4 or 5 years, and actually weirdly pre-COVID we had begun to turn that corner, and we're moving in the right direction. And partly that was to do with investments we'd made in people, not least in terms of our fundraising capacity and our ability to raise money. Also, I think through an organizational change program, we'd begun to really make a significant improvement in our kind of trading margins, our margins in relation to our project delivery. And also we'd seen growth and continues to see some growth in particularly areas of our activities. Social prescribing would be one of them, but a number of other activities, including some trading income, significant trading income through our consultancy work and some of our knowledge share programs. So there were streams of income that I think have given us some reassurance. The other thing I would say, and this does, others may pick this up as well, I mean, we are doing this because we have assets, and you know, I think in some ways we've been lucky with assets, and that we've been gifted some assets, and in other cases we've taken out mortgages many years ago in order to buy buildings and own buildings. And I think this has given us some stability at the moment, which is really reassuring. And I think, you know, to your point, Mel, you know, why would those who are lending us the money trust us to pay it back? Well, hopefully some of the reasons that I've outlined, but the kind of corollary with that as well is, of course, the trust that they are placing in us, having done, you know, huge amounts of due diligence on our organisation, is in and of itself leverage for us to use then when we're talking to other more conventional funders as a charity, which is hugely helpful.
Absolutely, thank you for that, Rob. Just going to check with you. I've been asked in the chat if we can share that quote from your chair. I've actually got that to hand. Are you happy for us to share that in the chat?
Yes, as much as you can, please.
Yeah, okay, I'm sharing it now because I had it ready to hand because I'd seen it somewhere else. So there we go. Okay, yeah, I think this is probably really important as well. I'm going to come back to the cost of capital when I've invited some of the other speakers in, but I think it's probably also important to say that the Recovery and Resilience Loan Fund was actually operated under one of the government coronavirus business interruption loan schemes. So I don't know whether you've seen CBILS as an acronym out there. And so the Recovery and Resilience Loan Fund was actually social impact investment sector's response to ensure that civils could be available to social enterprises and charities. I mean, technically, there was no reason civils couldn't have been. It's just that if you were going to a mainstream investor and they didn't necessarily understand your business model, it might have been tougher to do so. Just for everybody to know, that means that some of the things that Robert is talking about, like things like the interest-free period and the rate of interest, etc., a lot of that was actually mandated as part of the guarantee scheme that is backed by a government guarantee. Also, in case you find it interesting, there was about £28 million worth of money that was mobilised through the Resilience and Recovery Loan Fund, which I feel very confident is money that wouldn't have got out there had we not all have managed. It was a great piece of partnership working, and I often get asked how social is social investment, and I think it's probably one of the good things we can point to. But Rob, your question around you mentioned, and somebody else has mentioned about assets. So I'm just going to come back to, I'm going to ask Imelda and Iftikar this question about, you know, how important are assets to you in terms of raising money, and you know, it's there as a security, if you like, if you're taking, you talked to Imelda about raising some more secured investment, but you know, there are other ways to raise investment as well. So let me just ask you for a comment on how important it is. You know, what happens if you don't own buildings and assets?
Well, that's a good question for Yorspace, because we don't actually currently own anything. When it's your first development, of course, when it's subsequent developments, you can do all sorts of clever things to link them. But with the first one, of course, you can't do that. So I think what we're doing, I mean, we're going to ethical investors and mortgagers who are more comfortable with taking future value in. So, for instance, I mean, it's all down to timing, I think, if it's your first one. So if you are borrowing money, you don't lever the money in until, for instance, you've secured a freehold on the land. So immediately you've got the land as an asset. So what we have with Yorspace, we secured the land as an asset. We've also got the raise from the share issue. And then we've allocated the homes, so we've got the deposits lined up from the residents. So the other thing that is also important from Yorspace's point of view is the residents never own the assets, because we're allocating the homes on using a vehicle called mutual home ownership, an MHOS, Mutual Home Ownership Society. So you only buy shares in the wider development. It's collectively owned. So you can't have people making money and moving out. Mm-hmm. So you've got stability embedded in the business model. And I think that's another thing that helps. So I think in terms of how we present to lenders, one is, you know, where we are ethical and we are stable in terms of our business model. But, you know, there isn't profit embedded into the business model. So they know that although we're trying something a bit experimental and pioneering, we're not building profit into it. We're covering costs only. So we're looking at the affordability in perpetuity. And I think that's where the risk comes in, because certain lenders wouldn't want to share that risk with us, but the ones that we're talking to are happy to do that. So I hope that answers the question.
Super. Yeah, thank you very much. Iftikar, is there anything you want to come in there? If not, I've got another question for you.
Yeah, on this issue of assets, I'll just make a couple of points. So I talked earlier on about this kind of enterprising journey that our community-led board has gone on over the past 20 odd years, and having an asset with a value of £2.5 million on our balance sheet has given our board a enterprise for taking a mindset for taking risks. So they are more willing to look at bigger projects that require us to put our asset down as a security. So a example of that was a few years ago, Tesco had been land banking some putting major assets within our area of benefit, and then all of a sudden they decided they weren't going to build a supermarket, and they wanted to sell those assets. So our our board was confident enough to talk to Tesco's agents about buying one of those assets, which was valued at $1 million plus, and we talked to Unity Trust about the process of securing some finance and the kind of security that they would require. So I think it gives a community-led organisation like ourselves that level of confidence to engage in asset-based development at that kind of level. Yeah.
Okay. And I want to know, did you read my mind? Because you actually answered the question I was going to ask you next, which was about risk. Because there was a question in there post about, how do you take your trustees with you? We hear this a lot. How do you get that internal decision and internal buy-in? And I know, I don't know whether, Rob, that's anything that you want to reflect on. You said that, for 30 years or however long you're organised, you've maybe resisted that. But I know, how do you work to take your board alongside? I get asked this question quite a lot, is taking on debt morally wrong for a charity? And funny enough, I've just done a previous event, and one of the last things that the entrepreneur said was that sustainability is not the enemy of good. So I just wondered if you've got any reflection around taking your board of trustees with you as you've taken on repayable finance.
Yes, I mean, I think it is an interesting question, and there's kind of glib answers. The process of persuading people internally, both at executive level and at a board level, I think isn't always straightforward. And clearly, you do need to make the case. It's interesting, as an organisation, we've done things over the years which might appear quite risky. We built the first health living centre in the country, but effectively the first health centre in the country to be owned by the patients. And there was something quite radical that hadn't been done before. In some ways, what we're doing now is far less risky than that would have been, because it had never been done before, and there's all these kind of questions, and who would own the building, and how would that work, and what would happen if the NHS decided not to rent the space from us, all those kind of things. So I think part of the answer to the question is, it depends what kind of organisation you are, and for colleagues it will vary. And clearly, if you were coming to a board with a level of borrowing that was kind of very, very high in relation to the overall turnover of the organisation, and there was a limited kind of track record of trading, then that's going to be very different, I think, from an organisation where it's been around for a while and there's comfort in both in terms of the finances, but also in terms of the personnel and the sense of it feeling like a safe thing to do. So, but even with that, I think it has been, as I say, it was about an 8-month process that we were engaged in. The board were involved all the way through. A lot of the heavy lifting in our case was carried by the finance subcommittee, so the full board wasn't involved at every step along the way. I imagine that would be typical, but the heavy lifting was done in great detail with trustees, and I think the benefit of that is that we all feel secure. Well, it's not without risk, but we all feel that we're taking the risk together, as opposed to either the executive team proposing something that the board feels uncertain about, or indeed the other way around.
Yeah. Okay. Great. Yes. Thank you for that. And I loved again your point about it's a risk, but we take risks every day. It's just about the balance of risk that we take. There's quite a lot of questions in here about the cost of capital. There's quite a lot of questions about where to find investors, which Annie has helpfully posted in the link to Good Finance, where you can find a list of all the different investors. And I'm going to pick up a subsequent question, but there's a few questions around gearing and around what the sort of project ratio to lending is. But the one that I really wanted to come to, and it was actually a question for Iftikar, but Imelda, I don't know whether this is something you also want to look at. I know, Iftikar, you said at the beginning that like the first investment, I think that was Future Builders, wasn't it, from the first time around, that there was quite a piece of grant or a piece of that helped you to if you like, garner a much bigger package of funding. Actually, that's not at all unusual. There's some great examples of that, you know, so Stretford Public Hall, lots of organisations who often raise money using community shares, but then have to go on and raise other money to complete the project. I just wondered, in your experience, you know, is that how you've experienced it? That, you know, sometimes having an amount of investment in repayable finance can help leverage other grant and other support, pro bono support, alongside repayable. Is that something you've had experience of, Imelda?
It's not something that is not part of the formula that Yorspace adopted. No, I think we've kind of done it the other way around, in terms of looking at the cost of the development and then building in and working out what the gap is and closing that gap through raising through mortgage or borrowing, because we're trying to keep borrowing to a minimum. So I probably would say no, that hasn't applied to us, but that's because we've kind of done it the other way around, really. Okay, lovely. Iftikar?
Yeah, I think very much so, because that loan that we were offered by a venture capital fund through Future Builders gave us a lot of credibility with other funders. It enabled us to lever in. I mean, the overall capital schemes for purchasing and redeveloping the former school into a enterprise and community hub was about 2.2 million. So that initial £250,000 loan from a Future Builders was the first block, and that then opened the doors in terms of us getting fund from the Regional Development Agency and from New Deal for Communities, you know. So it definitely gave us that kind of strength to show that we are a serious player, and it enables us to build that capital package to achieve that much bigger project. Yeah.
Absolutely. Yeah, no, I definitely hear that. As I say, I've got organisations like, as I said, Stretford Public Hall that have raised both community shares. They've had large amounts of grant. They've also had some smaller amounts of debt. They've also done some crowdfunding. You know, they have some corporate donations. So this is a whole package, and again, not unusual. But I'm going to go right back to one of the questions that we were asked quite early on about, you know, what happens if you don't have assets or a building? Well, actually, our sector, social enterprises, charities, community anchors, generally, not always community anchors, but generally across the sector, we are asset poor. So we don't necessarily have the opportunity to add these things to our balance sheet. If we do, then great. And I hear lots of stories about, you know, there's a charity that I know in Bromsgrove in Worcestershire who had rented their head office and base building for sort of 20 years, came up for redevelopment, they needed to move. They decided to go down the journey and risk of buying their own building, which meant they took out a secured loan. And they took out a secured loan and an unsecured loan, and I'm going to come to that one because I think it's again answering another question. But actually, I remember the chief executive saying to me, I never actually thought I would say that borrowing money has saved me money and built the sustainability of my organisation, because they built their balance sheet, which they could borrow against essentially, and actually their monthly repayments on their loans were less than their rent. So, you know, in that situation, it was a win-win. And there was a question actually earlier on about, you know, what happens if you haven't got the deposit, you know, and you know, usually a secured lender will only do something lending we call loan to value. So usually either 70%, 30% or 60%, 40%, depending on their appetite risk. So you normally have to find 30% of the money. And what happens if you don't have the reserves and you haven't got that money and you haven't been able to get it as a grant? Actually, the example I was just talking about, the charity in Bromsgrove, they borrowed 70% of the money from a secured lender, a senior debt. And what that mean is secured against the property. It's a charge against the property. It's usually the least risky form of lending and therefore comes with probably the lowest rate of interest. But they also then managed to work, and social investors are great at doing this. it's not quite as competitive. They know who does what and work together. They borrowed the remainder of the 30% as an unsecured loan at a more expensive rate of interest, but still competitive, from Big Issue Invest, and that actually allowed them to put the package of funding together in order to be able to borrow the money. I'm getting lots of questions about who does what in terms of investors, and Rob has talked about social investment business, and Iftikar has talked about CAF Venturesome and Resonance, and Imelda, you raised most of your money from community shares. Have you engaged with any other social investors on your journey?
Well, I suppose I should say that the shares themselves are a form of lending. I mean, that's fairly obvious, but I suppose I should point that out. It's not going to, a bank and saying, lend us some money, but we do have to give returns on that investment. Although we do get round that, we do limit the risk to ourselves on that by capping it at 5% per annum of the total amount invested. So yeah, we get around it that way. In terms of, sorry, can you just repeat the question?
Just have you come across, have you spoken, did you consider speaking to other social investors, or have you come across, other social investors on your journey?
Yeah, well, we've talked mainly to our main the four legs of the table, I suppose, are deposits, the investors that come through as community shares. We've also got had some grant funding revenue, although the capital didn't happen. In terms of social investment, we've tended to go to the sort of triodos ecology type lenders, because in terms of houses and homes, they tend to be more familiar with that, and the amounts that we're looking to borrow are fairly substantial. Yeah. So that seemed to be the best mix for us, as opposed to the social investment route.
I mean, they are social investors themselves, and I think what you've just done perfectly for me is illustrated that something I notice is that social entrepreneurs and charity leaders, are all passionate about impact. So if we can get our heads around being enterprising and having a project that we need to borrow money from, what we really want to do is get from A to Z as quickly as possible, with A being, yes, I need some money, and Z is who will lend it to me. But actually there is quite a lot of finding out in the middle. Not all social investors do the same thing. So Imelda, you did that perfectly for me. Triodos, Ecology Building Society, Charity Bank, Unity Trust, which was mentioned as well. They are the main secured lenders, senior debt. That means that they tend to do like mortgage type lending. But then we have a whole raft of social investors in the middle who manage funds, people like Big Issue Invest and Key Fund, who operate in the north, and Yorkshire and Humber in the Midlands. And then we also have grant trusts and foundations, including people like CAF Venturesome, who essentially have philanthropic money, but alongside grant, they also do social investment. And the reason I'm making this point is because the average first time need of a social enterprise for a first lending is about £50,000. And we spend a lot of time talking about the cost of capital, how much it's going to cost. I mean, I'm with Rob, I want to pay it back as soon as possible. So, why wouldn't you want to do that? But, social investors will lend depending on the level of risk that they are taking and depending on where their capital comes from. And so I think it's really important for you to understand who does what in the market. Have a great quote from another social enterprise. Sorry, you can tell I've spent a lot of my career in the Midlands, so this is a Birmingham-based one, of an organisation who said they had to kiss a lot of social investment frogs before they found their social investment prince. Really what they mean is finding a social investor that shares their values and is the right type of lender for their business. And so I would definitely urge you to try and work out who the right type of lenders are for the sort of project you're doing, and then shop around and get to know them and find out a bit more. I think we are coming towards, we've had lots and lots of questions and I can see that we're not going to get to all of them. But I can also see it's there's one here about inclusiveness and about reaching communities who find access to finance a particular challenge. And so there's a question in here from Shirley about it's not easy to get funders for BME organisations, and I find it very difficult. Iftikar, I didn't prompt this when I promised, but I did wonder whether it might be worth just coming in on some of the work that we've been doing together around addressing imbalance, and how we are trying to tackle some of that by working with other organisations to get beyond the usual suspects, I suppose, in terms of how social investment might be useful.
Yeah, I think well, we've just started that journey, and we are using kind of examples of how organizations like ours have which are community led, based in very diverse neighborhoods, have still managed to go through this process. I think there's a lot of scope for further work on this. So it's a case of working with our peers, sharing our experiences, and just emphasizing that there's a lot of technical language within this social investment process, but in our experience it's very much around having an appetite for risk taking, and my experience of working within the community development trust and social enterprise sector in the West Midlands for the last 25 plus years is that organizations that are Black and minority ethnic led, they are enterprising organizations. There is that appetite for risk within those organizations, and it's just sharing organizations like ours, sharing our experiences, and just getting them over that initial kind of hurdle, in terms of seeing that it is feasible for them to engage with social investment. So we're going to be running a series of we're hoping to run a series of kind of networking events in the West Midlands to share those kind of experiences, and I think it's an interesting field to be working in at this time.
Thank you, Iftikar. And we're coming some more toward the end, so I'm going to ask each one of the speakers for me, please, one top tip. So with all of the people that are here, if there was one piece of advice or guidance you can give them that you would share, what would it be? I'm going to come to you first, Rob.
I mean, this might seem counterintuitive. I would say be cautious. I mean, I think this can all sound fantastic, and I think over the years we've taken out borrowings, not least in the mortgage we took out 23 years ago, and now with this opportunity with RRLF, which I think has been fantastic. And I think if I were asked the question, to what extent was the grant component an important factor in deciding to take the loan, then I would be a very dishonest CEO to say actually it was very significant for us. So the two things really were kind of went hand in hand. And I do recall, I remember, interesting, Iftikar referencing future builders. I think we worked with community builders many years ago. I got lost in the midst of time with all these different funds. But I remember we were looking at a major redevelopment of our site. We took the feasibility money from community builders with a view that we would then take the loan element. We took the feasibility money. We didn't do it cynically at all, but we took the feasibility money. We did that work, and at the end of it, we came to the conclusion that that wasn't the point in which we wanted to borrow, albeit on very good terms, significant amounts of money. So we played it both ways, and I think this is the right time for us, but other points in our history have definitely been the wrong time.
Absolutely, Rob, and I would echo that. It isn't any of our role or job to sell social investment, and I feel passionately that it's just about having enough information to know if and when it's the right tool for you, and having all of that information at your disposal. So fantastic. Imelda, your top tip?
Well, I would say very succinctly, have a plan B. If you're putting a funding package together, particularly for a multi-million-pound development, and particularly if it's your first, grants can disappear down the cracks at a minute's notice. You can find that you don't raise what you don't hit your minimum raise on the community share issue or something like that. Have a plan B.
Super, thank you. And Iftikar?
Yeah, having just gone through the process of developing 6-year cash flows for CAF Venturesome to try and secure some investment to develop our nursery, I'd say it's vitally important that you have good financial management in-house, or you're able to access it externally, because it's absolutely crucial that a financial plan that you've got is as good as possible. Yeah.
Lovely, thank you very much. Thank you, panelists. It's been a really, really interesting discussion. I'm just going to try and wrap our session up in the minute that I've got left or so. It might take me 2, but thank you so much for your contribution, and I'm just going to try and summarize. So this 7 lessons learned come from having run lots and lots of sessions like this, hearing from lots of peers. So nothing that I'm going to tell you are my words. They are organizations like yours that have taken on investment. So number 1, social investment is not benevolent money. I think I covered that right at the beginning. You have to pay it back. You have to pay it with interest. So it is making sure it is money that wants to make a difference, but you need to understand how you're going to use it. Impact matters. A social investor won't tell you what the outcomes are going to be. That's probably a bit different to maybe working with a grant funder, but they will want to know what difference your money is going to make. So you need to think about how you value impact and how you're going to tell that story. And that doesn't have to be really complicated formulas or lots of glossy brochures. It's about much more than the money. I hear time and time again, it's about the relationship. It's not just about borrowing money. I often hear that point around working with an investor can give you access to networks, or in contract negotiations, even better control of your finances, which I think comes to, actually I'm skipping to number 6, which is due diligence isn't fun, but it does make your business better. Honesty is always the best policy. Things go wrong. You know, what happens when things go wrong? All of the investors will say, do not stick your head in the sand and pretend it will go away. Tell them. They're used to things going wrong. And I've known social investors to lend more money or over a longer period of time, give capital repayment holidays, and a lot of that happened during COVID. Why isn't it cheaper if it's social? We covered that in terms of risk and who does what. So please do take the time to find out a bit more information. And again, Rob covered this really well for me. It always takes longer than you think. You know, don't wait for social investment until your back is against the wall. I have known social investors to turn loans around in 6 to 8 weeks, depending on how quickly their credit committee works. But usually they go at the pace that works for you and for them. It is often takes longer than you think that it will. So I'm going to summarize with those 3 top tips, which I thought were absolutely brilliant, actually, in terms of signing off for today. They were be cautious, have a plan B, and know your numbers. It's been a fantastic, interesting conversation this afternoon. I hope you've all enjoyed it. There's lots and lots of feedback in the chat, probably a few questions that we haven't answered. We will make sure that this listen on demand is there again. We've got quite a few links that we posted in the chat, which we'll follow up with our friends at Locality afterwards. But yes, I just wanted to echo a huge thank you to Rob, to Imelda, and to Iftikar for spending this time with us this afternoon. And Ed or Sarah, I don't know whether you want to do anything finally in terms of closing.
No, just to echo, it's been an absolutely fascinating discussion. I've learned a lot. And like loads of great questions. So yeah, really thanks so much for coming, everyone, and we'll look forward to seeing you all again soon.
Lovely. Thank you very much for spending the time with us. We'll talk to you again soon. Bye.
Thanks very much. Take care. Bye.
Bye.